good morning, judges. My name is Daniel. This is Lucas and this is Keegan. We are Team F and we are pitching a sell on Carter's Inc. with a 12-month price target of $41.44. While this does represent a 0.39% upside due to Carter's core fundamentals, we believe that a sell recommendation is warranted. Beginning with the business and industry overview, Carter's Inc. is North America's largest marketer of baby and children's apparel through their over 1,000 company-owned stores and various wholesale locations. While Carter's does boast operations in over 90 countries, about 86% of their 2024 revenue can be attributed to domestic sales. And we've also seen significant market share dilution in their market share in the US. And this is likely due to the rise of fast fashion such as Temu and Shein, as well as several macroeconomic headwinds, which we'll discuss shortly. Now looking at a share price history of chart, we can see that they've significantly underperformed both the market shown by the S&P 500, as well as their own competitors shown by Equal Weight Comps Index that we put together ourselves. Now looking at an overview of the industry, both the baby and children's apparel industries have faced significant headwinds in recent years. Elevated inflation has disproportionately affected both Gen Z and millennial generations, and this is Carter's target market base. And we expect this trend to continue into the future given that inflation has proven to be sticky. We've also seen declining fertility rates in the US as well as Canada and Mexico, which has reduced the overall market base for Carter's clothing. Moving on to our ESG section, the vast majority of Carter's aggregate emissions can be attributed to their supply chain. And due to significant leeway in the language in these supplier emission agreements, Carter's really has little control overall in lowering their supply chain emissions. In addition, we also conducted an interview with Sid Mukherjee, a retail industry expert, and he confirmed to us that Carter's lack of long-term contracts with both suppliers and transporters is extremely unusual in the retail industry. And this likely subjects them to daily spot prices in both purchasing goods and transporting them back to the US. In addition, their lack of long-term agreements also probably reduce their leverage in negotiating supplier emission agreements. Now looking at governance, we believe that Carter's management team has demonstrated a strategic misalignment with Carter's shareholders. We know that the vast majority of Carter's operations are based out of the US, about 86% of their revenue in 2024, and this means that they're missing out on significant opportunities for growth abroad in areas such as Africa, South America, and Asia. They have, however, expressed plans to move into Mexico, which does present a lucrative opportunity, given Mexico has a 2025 to 2029 projected industry revenue CAGR north of 4%. But we've yet to see any plans to actually move into Mexico materialize. In our investor relations call with Carter's management team, they voiced plans to open about 40 stores in 2024, the majority of which would be opened in Mexico. However, as of the year-end 2024, just 8 stores have been opened, further signaling the misalignment of interest between management and their shareholders, and this is well short of their original goal. One reason for that that management may be misaligned with their shareholders is that management team may be stretched too thin.
For example, after Michael D. Casey stepped down from the CEO position, Mr. Weissenberger became the new interim CEO of Carter's, as well as currently being the senior executive vice president and the CFO and the COO, all at the same time. Management has been doing a good job at decreasing the cost of goods sold, but still they couldn't figure out how to grow revenue and how to expand to other countries with higher birth rates. Taking a look at the graph on the left, we can see that Carter's executive compensation as a percent of revenue is above the average of the group peers. And taking a look at the graph on the right now, it is the same information but with our group peers, because we believe that our competitors are a better picture of the industry that Carter's operates in. Taking a look at Ralph Lauren, which is the only company that has this interest above Carter's, it seems more reasonable for them just because their 5-year stock performance has been 130% compared to only minus 52% for Carter's. We're not going to go over the financial analysis section. It seems like there is an agency conflict within Carter's just because it seems like executive interest is not the same as the shareholders' interest. And to picture this, you can see in this graph that the total compensation of the executive has been growing at a CAGR of 6.22% over the past 6 years. On the same period, revenue has been decreasing at a minus 2.66%. Taking a look at the table on your right now, we can see that if the surplus of this compensation above the average was not spent into compensation, that would have actually raised the diluted EPS in 2024 by $0.17. Taking a look at the graph on the left now, we see that Carter's had a big dip in net income, which was caused by a big dip in revenue. And knowing that the average shareholder equity has been remaining very stable over the past years, this is why the return on equity is also decreasing. This net income margin squeeze causes concerns regarding the sustainability of the dividends programs and the share buybacks. And as you can see on the graph on your right, over the past 5 years, it's been 3 times that Carter's had to give more than 100% of adjusted payout ratio, adjusted to share buybacks and dividends. That happened in 2019, 2021, and 2022, reaching 166%. We believe this is a poor allocation of their capital because we believe that there is better allocations to be done than to buy back shares that are now worth half the price to inorganically boost EPS and price your earnings. We believe that this money could be better invested into other investment or project like expanding to a new country to drive growth within the company, or into solvency management expenses. Because as you can see on the graph on your right, EBIT to interest expense has been decreasing over the years, while debt to equity is forecasted to more than double in 2026.
Next, looking at Carter's valuations. For that process, we looked at 3 different models: a dividend discount model, a discounted cash flow model, and a comparable companies analysis. For the first 2, we used 3 different pro formas: a bear case, a base case, and a bull case to help encompass all of our research and analysis. I want to take your attention first to Carter's unlevered free cash flow composition on our base case model. As you can see there, it's a dwindling trend since 2017, more so 2021, pushed primarily due to a decline in revenue, which is thus pushing down their EBITDA. Carter's has voiced that they're going to increase their capex going into the future. We see this more so as a risk than of an opportunity because their EBITDA continues to decline. The cost of equity, on the other hand, has continued to increase, as well as the cost of debt, pushing up their WACC, and thus Carter's is trading at a premium. This is further signaled by Carter's EVA spread dwindling down, while the ROIC has continued to decline at about 8.81% since 2017, while their WACC has continued to steadily climb at about 0.5% on the same time period. For our DDM, we use the same cost of equity as we did in our DCF at about 10.85%. It is pretty high. We use 3 different growth rates: a aggressive growth rate at 3%, a moderate at 2.34, and a bear case growth rate of 0%. Excuse me, over here. This should be 3% over here. Well, in that case, if Carter's were to reach a valuation of $73.77, they'd have to pay out about $7.47 in adjusted DPS and share buybacks. Why we did so? Because we believe that share buybacks in one way or the other is still returned to shareholders. On a comparative basis, Carter's EB to EBITDA has continued to decline, and even though this may seem like a good investment, we see this more so as a risk, as the enterprise value has declined at a much faster rate compared to the EBITDA, more specifically due to loss in market share. GMROI over here, which is gross margin return on inventory investment, has also continued to decline. You want to see this industry-specific metric a lot higher, which basically encompasses multiple different inventory calculations. This is primarily drawn down due to Carter's obsolete stock problem. In the end, we came up with a weighted average share price of $41.44 with a DCF of 50%, DDM at 45%, and the comparable companies at 5%. We weighed the comparable companies the least because a lot of our competitors, even though they do have a smaller segment of children's clothes, they have other segments that push their growth.
Now looking at our risk section, due to our sell recommendation, we decided to analyze risks that could drive an upside in our valuation. And in our analysis, we identified 2 key risks, the first of which being Carter's value return programs to their shareholders. Due to Carter's relatively stable dividend history, excluding 2020, we project Carter's dividends to grow at a relatively constant rate into the future. And if they're able to significantly increase share repurchases, this will drive an upside in our DDM of 78.76%. However, due to declining net income and free cash flow levels, we believe that share repurchases may prove to be unsustainable, which is how we modeled it in our base case, which drives an upside of 15.54%. But if share repurchases prove to be completely unsustainable, as modeled in our bear case, this will drive a downside of 29.78%. Our next risk is the risk for Carter's to improve its product mix, which will of course drive future growth and increase in margins. Essentially, Carter's plans to increase the volume of high quality goods that it sells in order to warrant about a 50% premium for these goods. But we do see a couple of different factors that may offset these margin increases, such as their plans to decrease prices of their typical items, such as their t-shirts, dresses, and leggings, and the near conclusion of their pack and hold inventory system, which was responsible for about a 50 basis point increase in gross margin in 2023. And we know this because they sold about 90% of their pack and hold inventory in this time. In conclusion, Carter needs a return to its former glory. Overall, we've seen the industry perform poorly. We believe that Carter's board of directors has performed poorly, allowing management to be overcompensated and demonstrate strategic misalignment with their shareholders. We've also seen significant inorganic EPS growth, as well as potentially unsustainable share repurchase programs. Therefore, we recommend a sell on Carter's Inc. with a 12-month target price of $41.44.
Thank you. We now open the floor to questions.
I'll kick it off, if that's okay. Forgive me if I'm not thinking about this right, but I think when you talked about some of your valuations, you were giving different valuations depending on whether they did share buybacks or not. Is that correct? Did I hear that right?
That's correct, yes.
I guess my question on it is, and I don't understand, because share buybacks is a strategic decision, correct? How that could impact the valuations or the valuation of the company?
That's a great question. We do believe in one way or the other that share buybacks also add value to their shareholders. We wanted to bake that in to our valuations just to project out if Carter's were to continue growing the way they are, what would the numbers look like. We do have another valuation where we did not look at the share buybacks, and so right here, for example, if you can see, this is our bear case, and this is what the value came, this is what it was $29 that the value came out to be. Yeah, so $29.50 was the value when we did not bake into our assumptions any share buybacks, and that does change when we further look at, it was about $52 when we did not take into any account any share buybacks.
Okay, so it's impacting your dividend discount model, is that?
Correct.
Okay.
Yes.
Can you talk about what drive decline in sales over the past few years?
Can you say that again, please?
What drove decline in sales over the last several years?
I'll let Daniel take that one.
That's due to several factors, the first of which being the rise of fast fashion, and we believe that fast fashion is kind of taking hold in the market just because inflation's been pretty persistent, obviously reached its peak in 2022, which has put a lot of pressure on consumers. So they've often turned towards a lot cheaper alternatives such as Temu and Shein. And we've also seen other macroeconomic headwinds like inflation, like we just discussed, as well as just declining fertility rates overall, which has reduced the overall market base for like the demand for Carter's footwear.
And you're talking about high inflation. How's the COGS as percentage of gross profit? How's the gross profit held? Does the gross profit improve or actually got worse over the last few years?
I'll let Lucas take this one.
So the cost of goods sold as a percent of revenue have actually been decreasing over the past years, over a long trend since 2017. But in absolute number, as you can see right there, it actually also dwindling over the years. So it has been decreasing.
And why is that, considering there's inflation? How they were able to bring the cost of goods sold down?
So they were able to bring it down for actually several reasons. First of all, the revenue decreases a lot. So inevitably, your cost of goods sold is going to decrease as well. And it happened that Carter's had a good strategy during COVID with pack and hold inventory. So they bought inventory at a very low price and they packed their inventory and they then sold it in 2021, 2022 at a lower price. So that was a good move from having spot prices on the market because again, they don't have long-term contracts, so they can just take the spot price.
So does that imply that going forward, their cost of goods cost of goods sold will go up, considering now they have to pay the real market prices?
It might be a possibility, but in absolute number, it will still go down just because the revenue might also be impacted. So if you sell more units, you will have a cost of goods sold in absolute number that is less than what it was previously.
In addition to that, as a percent of revenue, we do believe that it will go back up just because of the conclusion of pack and hold inventory. So we believe it'll increase by roughly 50 basis points. Their gross margin will decrease by 50 basis points. Their cost of goods sold as a percent of revenue increase by about 50 basis points going forward.
Thinking about the balance sheet for a minute, I think Carter has about $500 million of long-term debt, but it's coming due in 2 years, and it's got a 5.6% interest rate. Have you thought about what happens when that comes due and how they will be refinancing that and how might that change the projected bottom line?
I'll let Lucas take this one.
Could you go back to the graph on the debt to equity?
Yeah.
So they expressed willingness in their latest filing to refinance this debt 1 year earlier because it's finishing in 2017, maturing in 2027, sorry. So they will refinance it in 2026 and it will be at the amount of $500 million most likely because they've done the same thing in 2019 on their previous 8-year-old corporate bond that they contracted in 2011. So it is very likely that they will do the same refinancing with a bond of 500 million, and this is why the debt to equity is forecasting to increase in 2026, because the average shareholders' equity has been remaining very stable. So to project this, we had the equity staying very stable, and we added this 500 million refinancing to the debt to equity to have a forecast that is now more than doubling in 2026.
I guess I don't understand that. If they're just refinancing,
Yes.
why does that significantly increase the debt?
Well, because if they take a 500 million bond, that will increase their debt by 500 million.
They've been paying down, in addition, they've been paying down the debt that they currently have, and then they're going to refinance the rest of it, which will significantly increase the amount of debt they have on their balance sheet. If that answers what you're saying.
And what do you anticipate will be the rate on that new debt compared to what they've been paying?
Well, it will be probably higher just because of the environment they're in right now. So the rates are just getting higher. And also, this is another story, but talking about rating, maybe the Standard & Poor's and Fitch and Moody's might downgrade the company if they continue to have those bad results. So that might be also a risk to consider. So this is a pretty optimistic view on it, but it might be worse than that.
In addition, they also currently hold a BB+ from Standard & Poor's as their credit rating. And when they do refinance in 2026, assuming if they do get downgraded, it will be higher, but assuming they keep the same corporate credit rating that they have right now, their spread of their corporate bonds will likely be between 150 and 170 basis points higher than the 2 to 10 year treasury, depending on how long they refinance for.
Can we look at the slide that has your football field of valuations? Yeah. So the comps analysis here, how did you come to the conclusion to set your target price on the low end of your comps analysis?
Well, multiple different reasons. One, Carter's has, as you can see, price to earnings compared to its competitors is a lot higher. The price to sales almost there to the median, but still a little higher, and it's trading at a much lower EV to EBITDA. The first reason we want to do is we want to be on the lower end of everything because, again, Ralph, Gap, Under Armour, and Children's Place. Children's Place is almost going bankrupt now, and the other three companies have multiple different segments than just children's clothes. So we want to be a little more pessimistic when we chose the range on which we picked the number. That answers your question.
So if their competitors are going bankrupt and their valuations are low, shouldn't is that like dragging down your median valuation there?
Well, to some extent, yes. But again, Ralph Lauren is a part of the equation, and Ralph Lauren is kind of mitigating that downward that Children's Place, specifically Children's Place, is bringing down everything. So kind of mitigates and puts us right where the industry sees it.
I'm wondering about the 3 times enterprise value to EBITDA. Do you have historical numbers on that?
Oh yeah. So, as you can see, the light blue one is Carter's. It's continues to decline from, it was 11, I think 11.2 in 2017,
Okay.
and it's down there now.
Yeah, I'm trying to figure out if it's, looks like maybe 7 times there. Okay, that makes sense.
What has to change fundamentally as a company in order for you to change your recommendation from sell to anything else?
I'll let Daniel take this one.
We believe that the board of directors needs to do a better job of aligning management interests with the interests of the shareholders is the biggest reason that, or the biggest thing that we would change fundamentally about the company.
And what are those metrics that you would want them to align to?
First one, if we can go to the agency conflict slide, is this one right here, where we don't believe that management should have their compensation grow at a 6.22% CAGR in the past about 6 years, while revenue has been shrinking at 2.66% in that same time. We believe that's a misalignment of interests, and that has been a fundamental issue with the company.
So you'd like to tie management compensation to revenue growth?
As one factor, correct, yes.
Because in addition, this money could be better invested within the company, because if you can go back to 2 slides earlier. as you can see, the surplus that they give compared to the average, if they were just not spending that into the compensation, can you go back to the table now? That would actually increase many of their margins. So this is a very small adjustment, in my opinion, that could be done to significantly enhance the result of the company. And this money could be also better be allocating by just driving growth at the top of the earnings model by expanding to new markets. As we've seen it, there is many continents and other countries with high growth margins, and there is also Mexico that they try to get exposure to, but they still don't reach their own goals. So it seems like they are referring and voicing the will to go to Mexico just to drive short-term growth. But in the long-term growth, they just not do it. So it seems like they're preferring the short-term growth over the long-term growth, sustainable growth.
Last question.
Do you guys have a view on the overall US market, especially the small or mid-cap area? Because thinking about your football field slide, for example, a lot of Wall Street firms, instead of saying buy, sell, or hold, will say outperform, underperform, neutral. And the fact that the stock is at your median, valuation, 41 and change, looking out 12 months, if you're saying sell, seems to me it's implying that the market will go up and therefore you'd be better off owning the market.
I'll let Lucas take this one.
As you can see in the graph right here, Colors has been historically underperforming the S&P 600 and 500s, and in this case, we don't believe that this trend will change.
So you're more of a momentum player, not really a valuation buyer.
I mean, we're definitely institutional fundamental analysts, and we do not think that there is the fundamental required within the company to change the direction of the stock price right now compared to the market.